Hey, welcome back. Looking into some more of the stocks that you recommended. Again, really quick, if you have a suggestion or want me to cover any of these in more detail in the future, leave a comment and let me know. To begin with, The Buckle, they are a clothing retailer operating around 440 stores in the US. We can see quite a big decrease in revenue and net income in Q1, plus a significant drop in online sales. It may be the effect of cyclicality, but also a good potential indicator of the economy. Still, the margins were pretty good and they are developing as planned, so it wasn't that terrible. They are investing in expansion and remodeling some stores and they anticipate 7 new openings this year. Plus, they are moving and trying to pick better locations, which can have a significant impact on the future income. That has an effect on the CAPEX and the cash flow, but even then, they aren't doing that bad. Making over 200 million on a market cap of around 1.8 billion means a ratio of around 9, which is relatively low. It is pretty high for them, however, but when adjusting for the higher CAPEX, they are around the average. Something funny that I want to tell you, which might be important, I tried to look into the Q1 Q&A to maybe get some insights. I couldn't because it was literally 2 people asking 1 or 2 questions each. I haven't seen such a short transcript in years. You know, the lack of coverage from analysts and the media can lead to this company developing significantly without the market realizing, so looking into it before a lot of people do can be an advantage. Financially, they are in a great position, with the current assets almost covering all the liabilities. They have a lot of right-of-use assets, but on the other hand, they have 0 debt. That allows them to do whatever they want with the cash flow, and it offers a lot of flexibility in the future. They pay a pretty good dividend, which only requires around 72 million, so not even half of the cash flow. So they are in a very good financial shape. Keep in mind that this is a very competitive industry. You have hundreds or even thousands of powerful competitors which can rapidly eat the market share. And this is kind of a dying business model, which is why they move away from malls and shopping centers. But they manage to develop slowly and steadily in time even with the high competition, and they are taking action against the trends. On the other hand, they can slowly develop in other countries. Despite being 70-something years old, they don't have a huge international presence. It would be quite an investment, but it might be the next step in the company's evolution. You know, a couple of stores in France, Germany, UK, plus a focus on digital sales in the region can become the company's growth engine. They have the balance sheet and the possibility to issue stocks to support it. Again, a handful of physical locations plus a big focus on digital and marketing could add quite a bit to the income. Some of the top management has been in the company for even more than 3 decades, so they have a lot of experience, but do they have the vision needed to navigate the transition? You know, they can be like, I've been doing this for 3 decades, it's working, so why change it until it's too late? They don't seem like that type of management, but you can never know. So overall they are in an interesting spot. They have no debt but are in a branch that has a pretty bad future. But they have good margins and seem to try to move outside of the negative trend. Maybe if they focus on digital plus marketing and international expansion, this can continue to deliver pretty good profits. Right now at around 9 to 10x the cash flow and without any debt, they have a lot of flexibility, and if they use it, they can grow quite a bit. Even if they just maintain the current level, they can pay a pretty good dividend and maybe even increase it. But if they don't and waste the current potential, it can easily crash. I would prefer a better margin of safety, maybe around 25-30 for a 5-6% dividend, it can be okay. You know, it's a very profitable company with 0 debt, so maybe there is even potential to see a bigger competitor buy them eventually. Now VW, they are one of the largest auto producers on the planet with a roughly 10% global market share despite some inventory issues. We can see higher CAPEX despite lower cash from operations, leading to a negative cash flow a year ago. Surprisingly, they had some very good years due to the pandemic, but before that they were barely breaking even or had a lot of scandals, so nothing to brag about. Financially, they are in a very good position, with the current assets covering the current liabilities and the total assets well above the liabilities. So you get 200 billion in equity, traded at a market cap of 50-60 billion, so a very big discrepancy. It's interesting to note that half of the company is the car manufacturing that everyone knows them for, and the other half are the financial services surrounding it. A thing to keep in mind is that this is among the most terrible industries during a recession. A car or a fleet is usually a big commitment for a person or a company, and taking that during a time of economic uncertainty and stress is usually not common. However, this is one of the industries where you can have pent-up demand. You know, if you don't buy the car today because of a recession, you as an individual or a company will probably buy it in a couple of years. Either you build a budget during that time or the rates get better. This is usually demand that doesn't just go away. Also, they can benefit from rate cuts, which would stimulate the demand. So we could realistically see another upcycle before something eventually happens. Another thing to keep in mind is politics. In Europe, we can see a clear steer to the far right recently, which may be an issue for all the investments they made in EVs. Sure, it would be much worse for fully electric companies like Tesla, and if you think about it, that means more time for traditional car manufacturers to prepare. We can see the EV transition slowing down even before the political change from many companies, including VW. But you know, politics and politicians are unreliable and unpredictable and a few more things, so you can count on what they say. We can see, however, that the EU has finally added some tariffs on Chinese EVs, which might be enough to make the locals more competitive. The US also quadrupled the tariffs on Chinese EVs recently, so in the past few months things have been pretty good for VW or Stellantis, for example. Sure, it affects the production they have in China and can affect the sales to the country if they retaliate, but they don't have that much exposure anyway. This is mostly bad news for BYD, NIO, maybe even Tesla a bit, and overall good for VW, Stellantis and the others. The stock doesn't reflect it right now and it had a negative reaction, but this has a good long-term impact. But again, politics can change and the tariffs can be lifted or lowered, so I wouldn't count on them in the long term. And finally, remember that the Porsche family owns about 30% of VW and over half of the voting power, so they do anything they want. If they want to milk massive dividends or a full focus on EVs no matter what, that's what VW does. So, as we saw before with other companies, you are just allowed to partake, your opinion doesn't matter. Now, it's been like this for over a decade and I don't think they would be crazy enough to ruin such a company, but it's something to keep in mind. You know, things like splitting Porsche, which the family now controls almost entirely, may not always be in your best interest. I talked about them in a previous video, by the way, make sure to check it out. So, overall this is not a terrible company, but I wouldn't pick them over Stellantis. I prefer Stellantis for a few reasons, especially the balance sheet, the management and the cash flow. I think for VW this is a good price for what they can offer, but there is definitely more volatility ahead. You know, comparing them to Stellantis, that one is doing better and better and VW seems to be in a bit of trouble. So high interest rates for longer or a recession can definitely send them into much bigger issues and can rapidly deteriorate the balance sheet. Now, Build-A-Bear, you probably know them from some TV shows like me, or maybe you saw one physically. It's a very self-explanatory name, you go there and buy or build a bear or another plushie. This is all about the experience and customization, and they develop that into quite a big business. They operate their own stores, but also do franchising in other countries and third-party locations in Walmart, hotels, amusement parks and a bunch more. They have licenses from many popular brands like Star Wars, Marvel, DC, Harry Potter, Pokemon and many others. The stock has kind of followed the company's popularity and now we can see a resurgence. To get an idea, during the lockdowns this was 10 times cheaper, so it would have been one of the best buys possible during that time. Since the pandemic they have grown significantly and we can see that in the cash flow. For a 350 million market cap, they made even as much as 46 million, which would put them at a very good ratio. They have a new strategy since 2022, which might be behind this. They are focusing on diversifying the business model, reaching new customers and digital expansion. We can see huge growth in e-commerce and overall the plan seems to be working very well. If they keep it up and deliver even 5 to 7% growth as they expect from this point, this can become a very powerful business. I think they are at such a low ratio because the market wants to see more reliability. They had 2 previous rise and falls and if that happens again and they barely break even, that's easily a 60, 70, 80% crash from the current level. There is a lot of momentum and partnerships, but the management has to play this very well. I think that's why even after a 10x, this is at a relatively careful and even cheap valuation. Financially, they are in a great position, with the current assets almost covering all the liabilities, although they don't really own a lot. There is about 130 million in equity, a majority of that being in right-of-use assets, which isn't great, but I think this could even be bought by another company for the brand alone. It would be pretty cheap for a company like Disney, for example, and they could really leverage the IPs and develop this quite a bit. Think about all the series they could turn into plushies, many of which are already there. Plus, there is potential for global expansion. Even now, they don't really have that many locations, despite being very popular. If they can develop and offer this experience more in the US, UK, Canada, France, Australia and so on, they can easily multiply the revenue. For that, they need money, and I think the best way to do that right now is issuing shares. Even 18 million, meaning about a 5% dilution, would double the CAPEX, and in half a decade or a bit more, they can have a global presence and then grow bit by bit in each of these countries. And then, when they can reliably make 50, 80, 100 million per year in cash flow or even more, they can grow organically without having to issue. Because think about it, if they wait and waste the current momentum and don't deliver the growth that the market expects, the stock crashes and they are back to nowhere and the opportunity is gone. If that happens, this can easily be a 3, 4, 5x depending on the multiple that the market will trade it at. You know, 100 million at a ratio of 20x, which isn't even such a high ratio, means a market cap of 2 billion. That's a price of 145, meaning more than a 5x. Sure, this would be like the best case scenario, but it wouldn't be impossible. They pay a decent 3% dividend, meaning around 11 million, so very sustainable today. A year ago, they also paid a special dividend on top of buybacks. I don't think that's such a good thing to do now, unless it's a way to attract demand to the stock to later dilute it. You know, if they celebrate a bit too early, that can maybe waste the potential. But if they stabilize the cash flow at even 40 million, that's more than a 10% potential yield, so it wouldn't be terrible, but again, it would be a waste. Even if they just focus on marketing, franchising and opening a few more locations, there could be some growth. So there is a lot of potential, but it's really a matter of management. If I see them issuing shares, that would definitely be a green flag for me, even if the market may not like it. The financial health is good and there is even potential for an acquisition. I'm adding this to my watch list and will keep an eye on it. I wouldn't call it a buy right now because I want to see more stability in the cash flow. Even if it's not a lot of growth, I want to see that, they aren't getting back to breaking even again. Now, AMC Networks, they are known for Breaking Bad, Mad Men, The Walking Dead and a few other series. As a parenthesis, they aren't the AMC that people think when hearing the name. That is American Multi-Cinema Entertainment, this is American Movie Classics Network and they have nothing to do with each other, not even the ownership. It's funny that during the hype, a lot of people bought this instead of the AMC that they thought. It shows how much research effort was put into that. Again, they don't have and never had anything in common other than the name. We can see pretty big drops in revenue and net income, but this is a combination of having some particularly successful series a year ago and the normal business decreasing. This is somewhat normal in the industry and we can see the domestic revenue, for example, falling by 14%, but when adjusting for a successful series from a year ago, it's only a 6% drop. Something very impressive is that they made 144 million in cash flows in Q1. This is a $500 million market cap company and we saw them making even more before. Still, even if they make 150 million per year, which is close to the worst they did in recent history, that's a very good ratio. But this company was making even 400 million on average, so what happened? The problem is that, sure, they had Breaking Bad and then Better Call Saul, which they don't fully own, but as good as they were, this series ended. And if you want to watch them now, you don't have to pay AMC to do it, they are on Netflix and also Prime, I believe. They have The Walking Dead, which they spun off into a bunch of series, which I think was a smart idea because now, together with Shudder and Acorn, they can be the go-to for horror, drama, mystery series, which is a niche that can interest a lot of people. They plan to launch standalone ad-supported versions of all of this next year, and there is also potential to grow internationally. I think if they reorganize the offer a bit and have this kind of international focus, they can do even better. Financially, they are in a pretty good shape with the current assets covering the current liabilities, and overall, despite having a lot of debt, they also have quite a bit of cash. There is 1.1 billion in equity, or $500 million after the goodwill, traded at a similar market cap. They did some refinancing this year, and that's where the issues kind of begin. So they issued 10.25% yield bonds to buy back 4.75% ones. That's more than doubling the interest, generating around 50 million per year in additional payments. In total, they now have to pay around 175 million per year in interest. Add 100 million in stock-based compensation, and that's quite a bit of money on top of debt repayments from time to time. They had a 1.5 billion buyback program, and that led to nothing. They have another 135 million left, and it might be a good time to use it. But if they use that money to pay back a majority of the debt, they would have been in an amazing shape. And then the stock would have probably followed anyway. The same people that decided this are in charge of shaping the company's future. I'm not saying it was a bad time to buy them, but considering the balance sheet and the IPs, that shouldn't have been the number one priority. You know, the stock crashed because the market was worried about the company's future. The buyback solved nothing or make it even worse if they issued debt for them. Anyway, I think there is potential to see a competitor buy them. A 3, 4, 5 billion enterprise value for a company that can produce around 400 million per year wouldn't be terrible. They give exposure to a very popular niche which others don't really focus on that much, and there is also potential for global expansion. Overall, this is a pretty good company at a very interesting valuation. I think right now the margin of safety is very good because if the management is okay or someone buys them, this can easily be a 3, 4, 5x or even more. It's already very cheap and sure, it can fall even more, but at some point if they just continue what they do, even 50 million per year in buybacks would have a huge impact. But I think they are in a position where they can really thrive if the management is good. So I'm adding this to the watch list and we'll keep an eye on them. So a bunch of interesting companies once again. If you have a suggestion or like any of these, make sure to let me know in the comments. And finally, please check out the other episodes in the series as well, we got to quite a few so far. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.